Hey guys, it's Chris Wong here. I'd like to talk about some tips I think Warren Buffett used over the years and what he suggests for other people. Now, as a disclaimer, I am not a financial advisor or planner, just a guy who's interested in building a portfolio. So these are things I picked up from watching YouTube videos and reading different websites. So I don't know what's actually correct, but I do use some of these concepts for myself. So the first thing I think that's important to him, and I think it's important to me as well, is time. So you gotta invest for a very long time. And he started at the age of 11, according to some websites, or maybe age 14. I don't know which one's correct. So let's just say that he started at the age of 11. That's a lot of years he's been investing. And he's like 90 years old today. Investing is not something you can become rich quickly. And it actually took him a while for him to get his first million and eventually his first $1 billion because the amount of time he spent investing. Some sites said he didn't become a billionaire until like after the age of 60. Now, I don't know how correct that is, but let's just say that in order to achieve $1 million status, you need more time. So if you haven't started investing yet, start today. If you're afraid to invest, start learning. The whole point of overcoming confidence to invest is start now, learn to make some mistakes, learn from them, and you will achieve a good portfolio later in life. Time in the market and experience is what will help you overcome fears. The other important concept, in addition to time, is being patient. So investing is not something to get rich quickly. In order to become rich over time, it's consistency and it's time in the market, and you gotta be patient. So Warren Buffett didn't get most of his money until after he was like 60 or 70 years old because at the time it was in the market. So most of the growth happened in his later years. And because he started at age 11, or age 14, the amount of time it took to 60 years is like 49 years. So that's a lot of time. And the difference between, say, 49 years and 40 years is going to be even much higher than between 30 and 40 years of consistent investing. So patience is the key in order for long-term success. Now, one of his most important concepts he talked about, or what I've seen on the website, is be fearful when people are greedy and be greedy when people are fearful. I don't know if I got that in the right order, but pretty much is when people are greedy, then that's the time to be fearful. And when people are fearful, and that's the time to be greedy, and that's the time to take advantage of the opportunities. Now, for example, people are actually greedy when the market's going up. And when there's a recession coming or when there's a stock market crash, people are becoming fearful, and that's when they sell off. So that's a time for some people who actually know about investing to actually become greedy and start taking advantage of the opportunities. Low prices in the stock is like it's on sale. As long as you know what you're investing in, that's the opportunity to take. So some things I read on websites or picked up from watching YouTube is that over the years, he knew what the opportunities were, and he learned what stocks to buy that were undervalued, and he invested in them. So one of the important things Warren Buffett believed in was always understand your investments. Now, according to some websites, if I read it correctly, he did not invest in Google because he did not understand it. So he stuck with things he understood. And in the long run, it still paid off because his stock portfolio still grew. And even if it dropped, in the long term, it still grew. So applying this to myself, if I want to invest in funds, I need to understand what's in the fund. I need to understand how the dividends work and know the long-term process. I may not understand every single thing of the fund, but I make sure that the ups and downs kind of correlate with the indexes and the dividends I get. Am I getting them every single month? Am I taking a huge risk? Learning how to calculate them. Depending on how much you want to invest in certain funds, or if you want to invest in single stocks, the more money you want to invest, or the bigger percentage you want to invest, the more you should understand the funds or the stocks. So that means you have to read up on financial statements to invest in single stock companies, and that's what you got to do if you want to put a lot of your portfolio into these companies. Now, if it's just like you're buying like 2 stocks, maybe you may not want to read the financial statements, but as long as you know what you're investing in and you know the price you pay in the event the company goes down. Now, use a similar concept to buying ETFs or buying funds that have different companies within them. So as long as I know which companies are in them, or as long as I know how many sectors they cover, then that's how I know how much risk to take in investing. One of the next important concepts mentioned on websites or YouTube videos was he believed in holding the companies for a long term once he bought them. So as a guy who invests, I don't think about day trading. He doesn't think about day trading. He thinks about buy and hold it for a long term, and the company he invests in, it grows over time. And if it pays dividends, then the dividends grow over time. When I invest most of the time, I'm thinking about long term. I'm thinking about buy and hold. I'm thinking about collecting dividends. And if I do think about switching funds, I don't think about selling the funds just because I need the money right away. I think about selling funds only if I think there's another opportunity. So one of the most important things in order to build wealth is have to be frugal. And that's what a lot of websites describe him as. So he learned how important it is to be frugal, or it was just his personality, as he had a house since the 1950s or 60s, and he lived well below his means. So he never thought about getting a big mansion, and he never thought about looking very fancy. Applying this to myself, and I think many people should benefit from this, is in order to build wealth, in order to live a frugal life, you have to spend less money than the income you earn. So whether the income you earn is from your job, or the income you earn is from your dividends, or any other sources of passive income, your spending has to be less than your income. I hope this information is helpful. If you guys liked the video, please give me a thumbs up, and I hope you guys subscribe to my channel for future video updates. Thank you guys.